ETFs are rising very quickly in popularity, and the inflows into ETFs are about to surpass that of mutual funds, which have reigned supreme for the last 50 years. Now, there's a number of reasons that are driving this trend towards ETFs, but it's also very important for investors to understand that there are significant differences between an ETF and a mutual fund. There's a sea change happening in the entire investment industry where a lot of retail investors and investment firms like ourselves are moving more towards using exchange traded funds, ETFs, versus traditional mutual funds. But most retail investors struggle to explain the difference between an ETF and a mutual fund, how they operate, the tax efficiencies, how they trade, and we're going to focus on that today. On the surface, ETFs and mutual funds look very similar. If we're looking at, let's say, the Vanguard S&P 500 ETF versus the Vanguard S&P 500 mutual fund, both of those investments are trying to track the performance of the S&P 500. They probably have very, very similar holdings, but there are significant differences between those two investments. The first big difference between ETFs and mutual funds is ETFs trade intraday, meaning you can buy and sell your ETF at different prices as long as the market is open, whereas mutual funds, you can place buy and sell orders, but they all execute at whatever the price is at 4 p.m. This is one of the features that have made ETFs more popular over time. Is if something happens during a trading day, and you want to be out of that ETF investment at noon, you can do that, versus if you're in the mutual fund, you have to wait for the rest of the trading day to play out and it trades at whatever the price is at 4 p.m. The second big difference between mutual funds and ETFs is how ETFs are traded. So we just talked about when they are traded, but how they are traded, because they're exchange traded funds. And as the name implies, shares are exchanged between a buyer and a seller, much like stock trading is done, versus if you're trading a mutual fund and you want to sell your mutual fund shares, those shares are redeemed by the mutual fund company and they hand you cash. Because these ETFs are exchanged instead of redeemed, herein lies one of the greatest gems, is the tax efficiency associated with ETFs, especially in tax sensitive or taxable accounts. So if you own a mutual fund and there's all this redeeming and buying and selling happening throughout the year, they have to continue to sell securities to raise cash. That can then generate gains within the portfolio that have to be distributed out to the current shareholders, whether or not you sold your shares or not. And those are considered capital gains distributions, which usually happen in the second half of the year. So I could buy a mutual fund for $10,000. I didn't sell any of it during the year, but towards the end of the year, I received this capital gains distribution that I then have to pay tax on, just because the mutual fund had to buy and sell shares within their fund to meet redemptions. Versus an ETF, there are no capital gains distributions because those shares, the actual shares, are being exchanged, which means I do not realize a tax impact until I've actually physically sold my shares. I purposely keep referencing taxable accounts, brokerage accounts in my examples, because when we shift gears over to tax deferred accounts like IRAs, 401ks, things like that, it matters a little less from a tax efficiency standpoint, because if that mutual fund issues a capital gains distribution in December and it's in an IRA, it doesn't generate an immediate tax event because it's sheltered by the fact that it's a tax deferred IRA account. It only really matters if it's a taxable account, and then that capital gains distribution from that mutual fund forced me to realize income as a shareholder. Another feature that makes ETFs different than mutual funds is most ETFs only trade in what's called full shares or whole shares. They do not trade in fractional shares. So when you buy stocks, it's kind of the same thing. If, let's say, the Vanguard S&P 500 ETF is trading at $200 per share and you want to invest $300, you can buy one share for $200, but you're unable to allocate that extra $100 until you have enough to buy a full share. Where if you were buying the Vanguard S&P 500 mutual fund, you could allocate that full $300 immediately, because you can buy fractional shares of mutual funds. Which leads to one of the advantages actually of ETFs, which ETFs do not have what's called a minimum required investment. Some mutual funds will say, hey, to get access to this mutual fund or this mutual fund share class, you have to have $5,000 initial investment, otherwise you can't buy it. With ETFs, as long as you can afford one share, you can buy that ETF. Yet another advantage of ETFs is they do not close to new investments. Sometimes we'll have mutual funds they've been using for a very long time in client accounts, and they'll actually close and say, we're not accepting any new money into this fund, so we have to go and find another fund. Because these ETFs are being traded in the open market, exchanged between buyer and sellers, we don't really have to worry about getting closed out of an ETF investment. And with mutual funds, there's things called a hard close and a soft close. A soft close usually means that anyone who already has an investment can continue to add money, but if you're a new investor, you can't invest in that fund, where a hard close is that everyone is shut out of putting new money into that mutual fund. ETFs also have the potential to offer a broader range of investment strategies. So while you can normally find both ETFs and mutual funds that track the major indexes like the S&P 500 or the Russell 2000, if I wanted to say track just the performance of, let's say, the Brazilian stock market, there might not be a mutual fund for that, but there may be an ETF, because ETFs tend to get more strategic or finite with investment strategy. But that example brings me to one of the risks associated with ETFs, which is potentially liquidity risk. With mutual funds, I always have a mutual fund to go to if I want to sell my shares, to redeem those shares every single day. With ETFs, remember, if you're a seller, you need to find a buyer, and if you are in a very narrow or niche market, let's say you want to sell a large position, there might not be a buyer on the other side of that trade, which means I might be forced to hold those shares. So you just want to look at the volume that's traded within these ETFs to make sure there's enough liquidity that if you were to sell your position, you could do that easily. Similar to mutual funds, there are both passive and active ETFs. So passive ETFs, just like kind of passively managed index mutual funds, they're just trying to replicate an index, versus there are now actively managed ETFs, which function a lot like actively managed mutual funds, where that manager, that ETF, is trying to beat a specific benchmark. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.